Welcome. Okay, so we've heard a lot about the opportunity set, but how are the regulators treating this whole sector? Are they? I mean, if I can be possibly a bit unfair, in the UK, the government has been incredibly enthusiastic. I mean, one cannot fault the government in the UK, being really behind the sector. And let's say the regulators, though interested, are slightly more lukewarm, perhaps, about some of the risks, and I'm choosing my words carefully. And so we've seen a slight discordance between what government would like and what the regulators would like, and you get the sense the regulators are off doing other things at the moment anyway. Is that the same in the States? Who's going to throw in first? Go on, Claudia.
It's funny because I've talked about this with Diane Westerbach and with Susan Joseph, who are sitting there, and Susan just ran the New York Marathon, so let's give her a round of applause.
Well done.
As many of you know, crowdfunding for consumer loans is treated very differently from crowdfunding for commercial loans. The state of California is sui generis in how it treats anything, but the test case thus far in the courts was a Bill Me Later case in federal court in Utah, which was a wonderful venue where the first challenge was, you know, the bank's not really the lender, and there were states who weighed in on one side and another. The two regulators I've met with in the last month are schizophrenic. One, a big state, very populous state, says, yeah, this is being handled the right way. Another, not as populous, says, we have doubts here. When you look at a company like Funding Circle, which is a commercial P2P lender, came over from the UK. They are, usually you don't have entrepreneurs say, God, I've got a great idea, I'm going to call a regulatory lawyer. They clearly did. But I think that we are going to see this regulatory schizophrenia because in many ways it's a moneymaker for the states.
Yeah, Brian.
I think there's an interesting disconnect between the UK and the US. In the US, we have a culture where you only want to be regulated to the extent you absolutely need to be. And so many of these platforms benefit and their cost structures depend on this sort of run and hide approach. If you look at Lending Club and Prosper, they actually dodge 5 different regulatory regimes between the Investment Company Act, the Securities Act, Investment Advisors and Broker-Dealer Registration. The other question is, who is the regulator and what is their
I was going to ask that,
In the U.S., we are very fragmented. We have lending regulators, we have investment regulators, we have fund regulators, we have securities regulators. None of them are of the same mind on all of these issues. None of them can clearly speak with a single voice. And so there is a little bit of regulatory arbitrage going on in that if myself and Claudia and Doug and Georgia come to a position on something and we talk to the SEC or we talk to other regulators informally about it, and they say, yeah, well, this is a lot like this other aspect, which was never meant to be an online rule, that generally holds until there's some kind of challenge. And the big question a lot of us are going to have is, what is the challenge going to be, in what form will it come, and what is the likely outcome, and how can our clients best manage to not stand out as an outlier?
Okay, so let me put this to Douglas then. So exactly where I was going to get to. So you have a contested regulatory environment, no clear, obvious regulator in play, unlike the UK where there is at least one. You have a contested battleground. You have lots of probably case law having a big impact as it works its way through the court, different state state regulations. Is the overall thrust that if something goes wrong and an institutional investor in this room loses money because they say they put money in small and medium-sized businesses, the default rate's surprise to the upside, should they assume they're going to get a call or a knock on the door from the regulators going, you know what, we've changed our mind now. We actually think that thing was a lot riskier than it was when you started it. And in fact, you really shouldn't have been lending money to these small businesses, should you?
That's a great starting point to any conversation who's entering the crowd finance space in the United States. Unfortunately, it's not the way it is in the UK or other jurisdictions in the world. And it's not just the confusion that both Claudia and Brian are talking about. There have already been hostile acts by regulators in the space. And I'm going to act as much of a fan as I am of what the SEC does in principle. In practice, they're putting chilling effects into place by putting out phone calls, investigations, and subpoenas in certain cases to certain platforms inappropriately. And in all those instances that we have worked on to date, which are not insubstantial.
I mean, double-digit numbers?
Double-digit numbers.
Right.
Whether it's state, federal regulators, we have gotten our clients. The clients have been properly schooled by any of these professionals or ourselves to do it correctly. So in short order, you send over the zip drive and the regulator can see that you've done it exactly in accordance with the way the rules have been written, and they back off. But the fact that they take action without just informally inquiring and saying, this is a new program, we'd like to see what your methodologies are. It's actually, if you're a young professional or an entrepreneur and you get one of these investigations, your anxiety level shoots up until you get somebody on the phone, and then ultimately you disprove their concern. And that's what's been going on. And I can only tell you, of these stories that I've been told so far, industry is winning well over the regulators so far.
Okay, but I think you probably know where I'm going to get next question as well. Georgia, I'm going to ask you this as well. So if you as an institutional investor show due process and that you've gone through a proper due diligence process and you've documented stuff and you've gone through it all and you've shown that you've done the right thing, you're saying, Doug, is that by and large you stand a better than even odds chance of surviving that encounter. But what happens if the regulators just turn around and go, the whole asset class, I mean, effectively, you know, in the future, the whole asset class is toxic, and you really shouldn't have done it, and we don't really care that your due process was followed because you shouldn't have. Well, how do you protect yourself at that point?
Yeah, and well, also it's really important to note the distinction in the types of investors you're talking about.
Agreed.
So especially if you're talking about, you know, a sophisticated institutional type investor, we do have a philosophy that basically, you know, provides them with less protections, and we understand that they are, you know, able to bear the burden of that risk. Versus, I think, in a situation where you're talking about a retail investor, you know, a widow or an orphan out there, it's a significant risk, and I mean, I think that's kind of the problem. I want to just go back to your hypothetical about somebody coming in ex post, like after the damage has been done, and saying, now we're going to shut down this industry. As Doug pointed out, that's really not even the concern right now. Right now, they're shutting it down before it can even start. And
so the horse hasn't even bolted the stable yet.
Absolutely. Like the ex post, that's really the story of regulation in this country, period. You know, we have a big financial crisis and we then overregulate it. But the real issue we're having in this country, unlike the UK, where the regulators have taken a step back and really allowed the market to develop and been able to then apply some really thoughtful regulation and even incentives to the market, here we are in a lockdown. And much of the industry cannot even move forward or develop because the regulators have a stranglehold on it.
Sorry.
The story that I think you're alluding to, which I think is telling and people have to be mindful of it, is there was a debt lending site called SomoLend, and SomoLend is no longer around anymore. And the lesson there is that a state regulator decided to make an individual who I'm very fond of, make their cause celeb, and inappropriately, in my mind, notwithstanding the stated suggestions of impropriety, I think the state regulators were completely off base and vindictive.
Right.
And that just goes to the system we have in this country also, which is this bifurcated regulatory regime where we have both the federal regs and the state regs, and you have an opportunity for a state regulator to just kind of go off book. And
we could call it regulatory arbitrage.
And what I was going to say is, if you look at, and I know that everyone in here is a sophisticated consumer of regulatory advice, probably. But with our trifurcated regulatory regime, if you looked at it geometrically, if you did the proof, you'd say, you know, number one, banks can export the interest rates of their home state.
Yeah.
So let's put a bank in there. Number two, if you properly document a security, and so that's why you see that structure, especially on the consumer side. I think the thing that will, hey Howie, I think the thing that will really change, the game changer, is going to be what happens on the commercial lending side. And so much of that is going to be from the documents that the lender has with the borrower, making sure it really is a commercial loan and not being used to buy milk and bread, that sort of thing.
Just on picking up on that, we're going to talk a bit this afternoon about securitization. And obviously, securitization, you're using notes of common practice in the consumer space anyway, but we're going to see securitization also emerge and packaging together. In the consumer space, that obviously is happening and is going to happen more and more. In the small business sector, though,
it's my partner Howie Schickler, who's with our securitization group. We're working on that right now. Diane and Susan, as actual people in that world, have worked on that as well. That is happening, and this is an area where the T's have to be crossed, I's have to be dotted.
I was exactly going. You probably know. I'm going to ask, in that securitization of small business loans, are you going to have to really, really watch absolutely everything? Because it's one thing for you to get a whole bunch of A+ consumer loans, from a big, well-known platform, loads of transparency, stick them in the securitization and sell it. Slightly different in small business, isn't it?
Well, yes and no. I mean, small businesses in many ways have a lower default rate than consumers. And consumer investors generally count on a certain default rate. And what's securitizable about consumer loans and what doesn't make for a good secondary market is that they're all sui generis. None of them are alike. You can't tag a QSIP on a loan and have it trade like another loan. They all have different borrowers. And so this is a lend and hold market, 3 and 5 year term, 1 year term. Investors who have a shorter time horizon are looking for liquidity. Securitization is one of the main distribution channels. And as long as the assets can behave and be categorized in a way where they will behave similarly, then a risk can be disclosed and a rating can be assigned. And people are going to realize that small business loans, just like any other asset class that gets securitized, are going to fall into a predictable default range.
So what would your view for all of you be that we've already seen a $500 million securitization so far, where we've seen some other talk of other, not quite securitizations, but near enough flows being turned into notes and so forth. Do you think we're likely to see hundreds of millions of dollars of securitization in the small business space in the next few years?
I definitely think that's possible. I think that you have, with securitization, so if you think of peer-to-peer as basically boats on a lake, looking for a safe dock to land. Securitization is a market that is wide open right now. It is conventional. It is being done in all different asset classes, and this is essentially taking peer-to-peer, which is tagged technically as an esoteric, and moving it through the securitization pipeline, which is a well-trodden path using investment banks. Securitization buyers are generally qualified institutional buyers. There's a disclosure system. There's custody arrangements. There's all sorts of verification issues. So in that aspect, I'm a lot more comfortable that there won't be a blow-up than I am in other areas, such as, do we need to be a bank? Do we need to have a consumer lending license? Do we need to have a license to operate a secondary market? Those are really the big gray areas and unanswered questions that, if you think about things that keep all of us up at night.
I was going to you raised secondary markets, I was going to raise that as well.
Secondary market too.
As well. So I've got the two questions really for the end, to finish off on secondary markets. Secondary markets are the great, they're the great elixir that everybody talks about. If we can get secondary markets in, we can get the whole sector really moving fast. But is it quite as simple as it sometimes sounds? I'll just set a secondary market up online and I'm sure I'll do it like that. And the second question is, it all sounds, because of this, I probably unfairly characterize as regulatory arbitrage, but because of this situation where regulators are not speaking with forked tongue, do you think we're likely to end up in a situation where actually the sophisticated private investor bit of the spectrum, which has been in existence, is not an unsubstantial bit of both Prosper and Lending Club, it's a small bit, but it's a not insubstantial bit. Actually, platforms are just going to go, you know what, forget sophisticated investors. We're just going to stick with securitization, institutional investors, because you know what, I just do not want to face a visit from the regulator in 3 years' time, all goes wrong, and Mrs. Miggins has, supposedly a sophisticated investors put all their money in a platform, it's blown up. And I just want to use institutions. So two questions for you.
To take the second one first, that's a fear that I have. I am very supportive of the industry, and I think it's great because it's allowing sort of a democratization of capital markets, and it's allowing a new investor class to really participate in a new and bold way. And so, it would frustrate me if that were the outcome.
Do you think it's going to happen, though?
I actually don't, because
Okay,
I think the market there is a market reason there, and so maybe certain platforms will choose to go one way, and others will go another. But I think there is a business case, and as long as there's a business case, people are going to do it.
Secondary market?
Secondary market is obviously the holy grail, but it is very difficult, and the regulatory regime in this country makes it quite difficult. So
what's the particular problem?
I've always said the person who can thread that needle and figure it out from a regulatory perspective will be, this will be the next big thing.
So Doug, what's the particular problem then with secondary market? It sounds simple.
Well, first of all, I just want to agree with George straight up and down. Those are both of her answers on 1 and 2 are correct. There are a lot of different reasons depending on what the product you're trying to do secondary market transactions on. I do mostly equity, less debt, but there's blue sky state laws that are involved. When you're dealing with certain of the debt lending platforms, those are registered securities trading on an exchange, so you don't have blue sky related issues, so that's okay. But once you come off a registered security, it's very difficult to do secondary market transactions. And if you look at shares posted in the second market, which made their whole business models on that, they're not doing that anymore because the liquidity really wasn't there even for pre-IPO deals.
The one thing I will say is on Monday, I'm arguing a case before the Minnesota Supreme Court about where a loan is made for purposes of whether a state can seek to regulate it. It's a dormant commerce clause issue. And that's going to have an effect on this, on the securitization, on the model itself, and then the securitization and risk-wise.
Again, just to finish, Brian, what's your opinion?
Now, I think that secondary market is interesting. I think that you're going to see generally institutional buyers. One common aspect of all regulatory actions in the U.S. is that somebody has to be a complainant. And right now you have a market that is relatively static. You have willing buyers, willing investors, willing platforms. Everyone seems to be getting along. And if no one is complaining, and we've heard this from the CFPB, we've heard this from a lot of regulators, there really isn't an issue for them to go after. And that's the key point. If you stay within the lines, if you're transparent, and if you're dealing with sophisticated investors, and the secondary market is not going to be for retail investors, it's going to be for institutions, and that gives everyone a lot of comfort. Securitization, even more so. You're talking about bundling of large pools of assets and sold off in ways that are done every day. So I don't see that there'll be a huge amount of uproar with respect to those asset class distributions.
We're on a bit of a tight schedule, so we're going to move on to the data for a second, but I want to put your hands together and say thank you very much for our colleagues on the regulatory panel. Thank you. Thank you very much.